This video is brought to you guys by me, my course on how to scalp trade the S&P 500, because by all means, that seems to be the only thing that makes any money these days. Now, I'm just playing on that. I might make a course on that, honestly. I might make a small course on that because it's literally the only thing that is making money. But besides that, we need to talk about a saying that I'm sure a lot of you guys have heard about. If not, you're going to hear about it. It is sell in May and go away. This is one of the most broad terms in the stock market that you could ever know about, right? This is equivalent of buy low, sell high, or what it feels like we've been doing over the past year. Buy high, sell low once the margin call hits. I have not got a margin call, and I make sure that I won't, but nonetheless, be very careful of margin in this environment because things could get a little bit worse before they get better. So I do want to talk about that, really go over the context of what it is, why it could be even worse this year, and kind of let you guys know what we're up against. So hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. And if you guys would want me to put a course together about how to essentially scalp the S&P, scalp different stocks and indexes that, honestly, it's the only thing that is making money in this market. I think it's a pretty valuable thing to learn how to do, but not financial advice. Do not take my financial advice. I'm just a guy behind a computer. You are liable for any decision that you do make. As well as that, if you guys want to come trade with me live in real time, link down below in the pinned comment. Unfortunately, I am not able to put out scalp trades because they can be 30 seconds or they can be, an hour-long trade. I just don't like to, help people lose money if they don't get in, get out at the right time. You really got to know this strategy. So just bear that in mind if you guys do join. But nonetheless, let's get into this video because sell in May and go away. It sounds a little frightening after the day that we seen yesterday. The S&P 500 down 3.63%. The NASDAQ down 4.17%. Here in 2022, we have not closed down 4% or more at all. At all. We were down 4% at one point and then almost instantly reversed. And we only closed down, I believe, 3% that day. But we have not closed down 4% so far. And this is a new 52-week low. So if you had bought into the NASDAQ, even back here, April 29th, 2021, things were great for a while. But if you had held, you are now down on your purchases. So absolutely wild. A new 52-week low today heading into May. So I think this video is quite appropriate. But even the Russell 2000 went down 2.81% and the Dow Jones itself went down 2.77%. Now something that I do want to point out is the Dow Jones went down 2.77, Russell down 2.81. Now the Dow is composed of 30 stocks. These are stocks that are usually dividend paying stocks. They've been around for a very long time. They're seen as like the least risky stocks in the stock market. They only grow a little bit. They're very consistent. They don't have like huge revenue swings, right? They're very consistent. Like your staple products that everybody knows about. Those are your Dow companies. Well, your Russell 2000 has really been taking a massive beating. Again, hit a new 52-week low, and I don't even know like if you had bought into this in November of 2020, you're now down on your position. Like you've almost reversed 2 years of gains in the Russell 2000. But the point that I wanted to make there is that the Russell 2000 is really starting to slow down its sell-off. It was not nearly as bad as the NASDAQ. Why is that? Well, because it's already down a lot. But that does not mean things could not get worse. Ladies and gentlemen, sell in May and go away is in full swing because when we start the week, it's going to be May. We also have the Fed meeting coming next week on Wednesday, May 4th. at 2 p.m. Now, you do have some economic data as well, which we will talk about here in another video. You do have like initial jobless claims, the labor report. You do have a couple other things that come out next week that could also move the markets, but definitely Jerome Powell on Wednesday. I mean, that is going to be the bread and butter of next week. That is going to dictate, like, are we seriously going to crash or are we going to see a bounce back? Last time that happened, right, we had the Fed meeting March 14th. The stock market ripped. This was a historical rally. So I'm not confident that will happen again. I'm hopeful, but I'm not confident. But let's talk about sell in May and go away. So what the hell is sell in May and go away? Well, here's the definition. It says, sell in May and go away is a well-known financial world adage. It is based on the historical underperformance of some stocks in the summary 6-month period commencing in May and ending in October, compared to the wintry 6-month period from November to April. If an investor follows this strategy, they would divest their equity holdings in May or at least the late spring and then invest them again in November or the mid-autumn. Some investors find this strategy more rewarding than staying in the equity markets throughout the year. They subscribe to the belief that as warm weather sets in, low volumes and the lack of market participants, presumably on vacations, can make for a somewhat riskier or at a minimum lackluster market period. And here is the key takeaways. Sell in May and go away is an investment. Well, that's just kind of what we heard, but it says from 1950 to around 2013, the Dow Jones Industrial Average posted lower returns during May to the October period compared with the November to April period. Since 2013, statistics suggest the seasonal pattern may not be the case anymore, and those who follow it may miss out on significant stock market gains. And it goes on to say the origin of the phrase. We'll just go ahead and read this because it's just one paragraph and it's interesting context here. It says the phrase sell in May and go away is thought to originate from an old English saying, not the alcohol, guys. No, man, not the alcohol. Old English. Sell in May and go away and come back on St. Leger's Day. This phrase refers to a custom of aristocrats, merchants, and bankers who would leave the city of London and escape to the country during the hot summer months. St. Leger's Day refers to the St. Leger's Stakes, a thoroughbred horse race held in mid-September in the last leg of the British Triple Crown. American traders and investors who are likely to spend more time on vacation between Memorial Day and Labor Day mimic this trend and have adopted the phrase as an investing adage. And indeed, for over half a century, the stock market patterns have supported the theory behind the strategy. Now, like we will see in this article, talking about essentially from 2009 until 2018, it was not always the case, but some years are really, really, really bad. Like, check some of these years out. So 09, we had a 5.31% gain. 2010, we had an 8.2% loss. 2011, we had a 1.35% loss. 2012, you had a 6.27% loss. 2013, 2% gain. 2014, 2% gain. 15, 1% gain. 2016, a 1.5% gain. 2017, 1.16% gain. 2018, a 2.16% gain. So, to some extent, you can see market rallies in May, but when it rallies, it's not usually all too good. Like 09 was, in May was one of those periods where we had already sold off a lot, so we did bounce up a little bit, and then we ultimately did sell back down. So May was a real phenomenon, in my opinion, in 2009, where you did see a 5.31% gain. Other than that, your next best gain was 2.16% in 2018, and then what happened? The stock market ultimately sold off again, right, in 2019. So some of these losses can be pretty bad. 6.27%, 1.35%, and 8.2%. That's not so good. That's not so good. And a lot of people follow this still to this day, even though it doesn't necessarily mean it's correct these days. It says, hold on. It says, not in 2019. If you follow the old adage, adage. I don't know if I'm saying that right. Just so you guys know, I have no idea if I'm saying that correct or not. But it says, during the first week of May, with the thought of returning to the market after Labor Day, you made the right choice. The S&P 500 delivered a 6.58% loss. However, you would have made the wrong choice 70% of the time had you followed the advice during this latest bull run. Let's look at the performance of the S&P 500 for the month of May, dating back to 2009, and this is, seen as the the latest bull run. Hopefully it's not coming to an end. I mean, if you guys have not seen my video that came out earlier, I mean, go check that out. I'm not trying to be the bearer of bad news here, but there's a lot that is working against us, especially this time around. Like, you have severe margin in the markets, severe margin. You have GDP slowing down. You have a Fed that is at a 0.25% interest rates. What if we went into a recession next quarter, which could be possible if GDP is negative? There's nothing to do. Like, the Fed can't cut rates. They can't accommodate the markets. They can't add to their balance sheet anymore in a huge way. Like, they're really forced here to act super aggressively. I think the Fed, after everything we're seeing here, will likely have to go more aggressive, because there's no way to help the economy once things get really, really bad. So, I don't want to be the bearer of bad news. I'll say that again. I don't know what's going to happen here in the next, coming months. But given where we're at in the economy, given the federal funds rate being so low, I think the Fed will have to go more aggressive than not, regardless of what is happening with inflation or not. Even if inflation ticks down, the Fed still has to be aggressive, because you have to be able to accommodate the markets if we headed into a major recession. The last thing you want is federal funds rates low, inflation high, and a deep recession that comes, right? So those are my thoughts on it. Sell in May and go away. A lot of people follow this still. And a lot of the big money is older. And you've seen people actually taking money off the table. If they have not, been taking money off the table voluntarily, they've been getting margin calls. And that's part of what you've seen on Friday. The S&P doesn't just drop 3.7% in a day just because it feels like it. I mean, those are liquidations. Those are margin calls. Like, that's what you've seen, during the early days of 2020, before the crash really started to get bad. These 3% days, it doesn't necessarily mean a bottom is here. But, last Fed meeting, like I said, we did reverse and actually started that historical rally. So it's very important. If you guys have not seen the video that came out earlier, go ahead and check that out. But that is sell in May and go away. Let me know your thoughts on that down below in the comment section. Thank you guys for tuning in. If you guys want to come trade with me live in real time, link down below in the pinned comment. If we do get a flash crash, we got a lot of downside exposure, or a flash crash. I mean, hopefully it would be a flash crash. If anything, hopefully it's not a long-term crash. We would do very well. So if you guys want to be a part of it, link down below in the pinned comment. If not, that is all fine. I hope you guys enjoy your weekends, and I will see you in the next one.